Luke Went, the in-house tax advisor for Wealth Distribution Strategies. I know many of you. Some of you I do not. And I do want to introduce Ryan. He is our new tax intern. He's in training, and he will be our full-time tax advisor in our Brookfield office. Wanted to thank Ryan. He did a lot of research on this project for today. Basically, I fired a bunch of questions on things that this is what I saw, and I tasked him with tracking down the details, so I thank him for that. So the items that we're going to discuss tonight are mostly involved with the new One Big Beautiful Bill Act. I'm going to just refer to it as the Triple B for brevity throughout the rest of the presentation. And we're going to cover kind of the extensions of different tax brackets, increases on the standard deduction, some changes to the credits, deficit updates, Social Security, Medicare, how those are going to be impacted, Medicaid, as well as you know, how businesses are going to be affected. And then there was also some changes to the Wisconsin tax code through the most recent budget reconciliation. So we're going to update that as well. For anyone who's not in Wisconsin, obviously that will not apply to you. And I do apologize, we can't go through every state, but about 95% of our clients are Wisconsin, so we do have to focus on that. First thing, pretty basic, the Tax Cuts and Jobs Act from 2018 brought in some of the lowest tax brackets that we've had, especially on the higher end throughout history, and those were extended. So we have what has now become familiar 10, 12, 22, 24% tax brackets, and those higher brackets are the 32, 35, and 37 at the top level. Standard deduction at the beginning of this calendar year was scheduled to be $15,000 for a single filer, and that was increased by $750. And that also flows through to the married filing joint as well. So let's get that. And head of household. So there's a slight increase on the standard deduction for 2025, and that is also scheduled to have a cost of living adjustment each year going forward. Big part of this law that's going to affect a lot of you in the audience is the over 65 increased deduction. So there's always been kind of an additional standard deduction for single filers or married if you're over 65, kind of a standard 2,000, 1,500, 1,600. So those numbers are up on the screen right now. If your income, modified adjusted gross income as a single filer, falls below 75,000 or 150,000 for married, there's going to be an additional $6,000. They're calling it a deduction, but it's really like the old exemption rules, because this will phase out, but it also is kind of not dependent on a lot of other things. Phase out is different for a single household versus a married household, because it phases out over $100,000 regardless if you're single filer or married. And because a married couple will have $6,000 per person, it's a $12,000 reduction of taxable income. So that phases out faster over the course of that $100,000 phase out period.
So, Luke, since they call this a deduction, what happens if you itemize?
So Ryan's asking about what happens if we itemize. If we do that, you are still going to be able to use this exemption. That's why I'm going to call it that, because the old rules, there was a standard deduction and then you had personal exemptions, and it didn't matter if you itemized, you would still get that exemption. Um, so yeah, if you're gonna write off a bunch of mortgage interest and state and local tax and have some medical expenses and give to charity, but you don't want to lose this extra $6,000 per person, don't have to worry about that. It will be included regardless.
Got another question.
Okay.
If I'm over 65 and my wife is not over 65, what happens in that situation?
So it is a $6,000 per qualifying individual. So in that case, just one of you would qualify for that. You would still fall under the married income limits, but you would only have that additional 6,000 exemption if one of you were 65 and the other was not, instead of 12,000. 2025, the lifetime estate exemption, or what is commonly called in the media the death tax, was just under $14 million per person. That was scheduled to reduce down to about 5 million. But with the new law, it does stay at a very high dollar amount. And next year goes up to $15 million per person. So basically what that means is you can leave a married couple, $30 million to your heirs, and there's no estate tax, no death tax on any of that amount. So I guess that's a good thing. All right. There's been a number of changes on how tax and overtime, or tax on tips and tax on overtime, are going to be calculated. I'm going to go over this briefly because most of members of our audience, this will not apply to, because a lot of you are in the great position of being retired. But anyway, there is a $25,000 deduction on tips for any tip position. This is going to be customary tip positions. So your delivery drivers, your wait staff, hospitality, that type of thing. There will be a comprehensive list published by the IRS. So there's no, well, I'm going to claim my income as tips so I can avoid paying taxes on $25,000. Um, that's not gonna work. You also have to have income below $150,000 for an individual, double that for if you're married. And this is a temporary reprieve. It goes from 2025 until 2028. Similar overtime is time frame is the same. It's only a 3-year reprieve, and it's a $12,500 deduction per person. Doubles if you are married filing jointly. This is only the amount that you're paid in excess of your normal hourly rate. So if you're a skilled tradesman and you normally make $100 an hour and your overtime is 150, you would only be able to deduct that $50 per hour up to that income threshold limit. And also your adjusted gross income has to stay below that 150,000 or 300,000 if you're married. So pretty complicated, just a lot of caveats there.
So it sounds like there's still taxes on tips and overtime. What about all of the emails and stuff about taxes on Social Security?
Right. So the Social Security tax is still in effect. So there is still tax on tips, there is still tax on overtime. It's just that you're allowed for deductions, and the previous conversation about that extra $6,000 of tax-free income for seniors over 65 um, is meant to kind of fulfill that promise of no tax on Social Security, which, it's still very much taxable income under the current law. There's a little bit of a change on charitable contributions for this year. Main one is if you are taking the standard deduction, you can claim up to $2,000 and still take that standard deduction of charitable gifts for a married uh, joint return, $1,000 for a single return. So you definitely going to want to make sure you keep track of kind of those cash donations this year, even if they're a relatively smaller amount under that $1,000 threshold or $2,000 threshold, because we'll get some credit on the federal return this year. If we are itemizing, this is new. We've never actually had limitations, but the first 0.5% of your AGI you cannot deduct. So this is very similar to how medical expenses are limited. The first 7.5% of your AGI, you can't deduct those medical expenses. This is going to work very similar to that on the charitable giving, that first 0.5% of your AGI. So we have a formula there. If your AGI is $100,000, the first $500 of charitable contributions would not count as deductible. So if you gave $5,000, you would be able to add 4,500 to that itemized deduction list. Also, again, more complicated than it probably should be, but that's just what's going on. There's some changes to what can be itemized. So SALT tax deductions have changed. New car loan interest is now something that's deductible. There's a little bit of change to education credits, child tax credits, and mortgage interest, that type of thing. So we'll talk about those in more detail. So state and local tax deductions were limited previously to $10,000 if you were itemizing. Going forward in 2025 through 2029, that's now going to be up to $40,000 that you can use on your SALT tax, state and local tax. That's what the acronym is when you are itemizing. And there is also a built-in cost of living increase of 1% each year in that 4-year time frame. So this includes property tax, sales tax, income tax.
I've got a separate question on the previous charitable donation slide. For when you're not itemizing, do non-cash contributions apply?
When you're, yes, when you're not itemizing, they will, to the best of my knowledge. So you'll need to basically document that. So if you're gifting to like Goodwill, that type of thing, I'm guessing is probably what that question is kind of referring to. It's going to be the thrift market value. So it's up to you to decipher what that market value is at that time. And yes, you can itemize those or deduct those without itemizing as well. Yes.
So what exactly are the SALT taxes?
So again, SALT is state and local tax. And if you look at the slide, it's property tax, sales tax, or income tax. So you can't use your income tax paid to the state plus everything that you paid in sales tax. It's one or the other, but you can then add on property tax. So it's a combination of basically those two forms of tax. If you're in other states and you have personal property, you can add that as well. Something that us Wisconsinites are like, wait, what's personal property tax? But if you're in a state that has it, you'll know. So this, because we have this much higher state and local tax or SALT cap, it brings back the strategy where you can double up your property tax in any given year. So if you've already paid your property tax for 2025 and you get that 2026 bill, and you want to pay that in December to double that up, sometimes it does make sense. We do want to be careful um, that we're going to have enough of a advantage to do that. Because if we don't pay any property tax in one calendar year, I mean, you run the risk of losing a $300 credit from the state of Wisconsin. Um, you can get around that by paying a partial in kind of those off years, as long as you pay $2,500 in property tax for Wisconsin, there's a $300 credit. So if your property tax is $7,000, you pay the majority of it together with another year to double up to try to itemize, and then just pay that to $2,500 the following year, or vice versa, however that works out. If we want to take advantage of the new law to deduct your car loan interest, there's some uh, red tape on this as well. You can deduct up to $10,000 of interest. Your AGI has to be below $100,000 or $200,000 if you're married. There's some vehicles that are not included in this. So if they're assembled overseas, um, and there's going to be a list published that you'll be able to find from the IRS that will determine how much of that vehicle is actually assembled in the United States to see if it qualifies to deduct that interest. It has to be brand new, and the loan has to be originated sometime in 2025 or after. Um, so it's going to include a lot of vehicles, but there will probably be some surprises as far as like what vehicles aren't actually assembled in the US. Um, it's about half of the pickup trucks are not made in the US, about half are. So when you're looking at, making that purchase, you're probably going to want to ask that question if you're planning on deducting that loan interest. There's an increase for child tax credits. So if you have a dependent child who's under the age of 17, there's going to be an additional $200 credit that's available. Phase out is going to be about the same. So there's not a lot of other changes. It's just a slight increase to kind of that child tax credit. And they did lower the threshold for how much earned income you have to have access to that tax credit as well. Something that was created with the new bill are being called Trump accounts. So newborn children are going to have accounts opened up for them, and $1,000 credit will be added to that account. This is something that you then can contribute to going forward. These are going to be tax deferred on the growth. They are basically going to be treated like IRAs. So when you take that money out, it will be taxable. There are going to be some exemptions that are going to allow you to access those funds before retirement age. And they're going to be very similar to IRAs as well, like new home purchase, use for education, those types of things. So this is really meant to kind of jumpstart saving for children. Um, the problem you can see at the very bottom there is we're expecting about 3 million children to be born each year. The funding for this only pays for the first 4% of kids born over the next 4 years. So there's a extreme shortfall on actually funding these accounts. And there's no explanation as to where that money will come from. So that will be something interesting going forward.
So I know you said that you can use these for qualified expenses like buying a new home or for college. So is this like a college savings account? or is it more like a retirement account?
So it's a very good question. There's a lot of ambiguity as far as what is this used for. There's going to be those exemptions to use this for college. You can only add to these accounts up until your age 18. So it's kind of a college account. Um, but when the current Secretary Treasurer was asked about these accounts, Scott Bessent, Reuters quoted him in saying that this is actually a backdoor for privatizing Social Security. So it sounds like the administration is looking at these more as retirement accounts than college planning. He then kind of backtracked that statement saying, no, we're not trying to abolish Social Security. But it was very interesting language that he chose when he made that statement. Education credits, there's really not a lot of change here other than they really emphasize putting in that a social security number is required, which was kind of always there. However, there was some room for um, documented worker or documented immigrants who were under the Dreamers Act. So they're now going to be excluded from any education credits at this point under the new language of the law. Um, there was a lot of emphasis on energy credits in some of the previous budgets and tax laws that was supposed to go through the year 2032 for things like solar panels, upgrading efficiency in the home, electric vehicles, those types of things. Those have all been compressed significantly. If you're wanting to buy a new electric vehicle to receive a $7,500 credit, um, I suggest you leave now to go start shopping because it has to be purchased by the end of next month. Otherwise, that credit expires. The used market, you get till the end of the year, and then any of those home upgrades are also going to go through the end of the calendar year. If you are upgrading your at-home charging station, that's going to go through the end of 2026, or I'm sorry, June of 2026, like it says on the slide there. So, um, yeah, if there was any plans to take advantage of any of these incentives, the time frame just got compressed dramatically. So, a few of you may have seen a 1099-K, and really what this is like credit card transactions, those types of things. So there was a reporting threshold of $600 if you receive payment as an individual. Corporations also have some law changes, but we're not real concerned with that. Now that threshold has been bumped up to $2,000. So you would not be required to report those transactions as long as it's below $2,000.
So why would I get a 1099-K?
So 1099-Ks, most common are going to be if you're receiving like royalties on some work that you've done previously, like if you publish a book through Amazon, something like that. If you're selling things on eBay or secondary markets like that, Etsy, art projects, that type of thing. Or if you're reselling tickets through like Ticketmaster, that type of thing, if those transactions total up to above that threshold, those third-party pay services are required to report that information to the IRS, and then it's ultimately up to you to kind of reconcile that and show how much of that was actually profit. So now we're going to look at the kind of 10-year parameters on how the budgeting of this tax law is going to affect Medicare, Medicaid, the Affordable Care Act, Social Security, and the deficit overall. So Medicare, there's not been any actual plan changes to Medicare, but through some of the reduction of taxation, the shortfall did increase or get closer as far as time frame goes by about a half of a year. So the trust fund is now planned to become insolvent through the middle of 2032. Medicare is in much better shape than Social Security as far as the trust fund goes. So the amounts of benefit that would be reduced would be 11%. So there's a couple ways that would be handled. Either Medicare will just kind of force that their payments are going to go down by 11% to the providers, or they're going to increase the out-of-pocket to the members who are on the insurance at that point, or a combination of both. So there's no plan or definition as to what will actually happen at that point. But it did get bumped up by 6 or 8 months or so. There was a lot more changes to Medicaid than Medicare. And the primary thing is who's eligible to receive access to Medicaid. And each state has its own name for Medicaid. Here in Wisconsin, it's Badger Care. Um, there's work requirements that are 20 hours a week, and you have to maintain income below basically the poverty line, um, which is at $15,000 roughly. There are certain states that minimum wage at 20 hours a week will actually push you over and above that poverty limit. So states like California, Illinois, um, virtually a single person, there's no way for them to qualify for Medicaid because if they meet the work requirement, they'll make too much money. And if they reduce their income just because they have higher minimum wages, they wouldn't meet the work requirement. So it's kind of a very strange formula that's not going to work for a lot of individuals. Now, people who have children, that poverty line obviously increases quite a bit. So it won't be as drastic of a change, but it still is going to reduce the availability for a lot of people uh, who are in those situations as well. So the projections on enrollees on the Affordable Care Act, Medicare, Medicaid, over the next several years, we anticipate, or not we, the studies that we reviewed anticipate that there'll be about 10 million people who will lose health insurance over, do you remember
I believe it's
the
next.
over the next 10 years? Okay. Double checking with Ryan. Um, so, third question.
Why do people lose coverage?
So,
So why are so many people ending up losing coverage?
so our in-house insurance guy, Shane, has been calling it the Affordable Care Act death spiral. Um, as people fall off of the ability to be on Medicaid, that means that they'll be forced to go on the Affordable Care Act, which is also underfunded, becomes more expensive, and there's also no enforcement to require people to have coverage like there previously was. So if you're young and healthy and you can't afford a premium, well, then you very well just might not go with coverage. People who are not as healthy, that are maybe a little more advanced in age, are going to want to keep that coverage, and chances are going to go see the doctor more often, which means that their premiums are going to have to go up because there are fewer people in the pool paying in those premiums. So as that increases, more people are going to not be able to afford that are younger, healthier, that are going to take that chance of going without coverage, which you see where it's calling a death spiral. That means people who are going to need it are going to have to pay more, have higher premiums. So it's not a very good situation. And to add insult to injury, they've already built in a reduction of subsidies. Um, so these are projected numbers based on the poverty limits in 2024. So these numbers are going to change, but not drastically. We're going to see maybe $1,000 plus or minus on the AGI cap. But basically, if you are on the Affordable Care Act right now and your AGI is over $62,000, next year you will probably not qualify for any sort of a subsidy, whereas this year you were probably getting around $6,000 or $7,000 per person. Um, so I'm sorry, that's single, not my area of expertise. So married filing jointly, it's those higher numbers. So 81, $82,000 AGI. That's where you have kind of that $17,000 subsidy that you're currently getting. That if you go above that threshold, it's a cliff. If you go $1 over, you get no subsidy. If you're a dollar under that limit, then you would qualify and get that $16,000 subsidy. So becomes a very, very brutal, very fine limit calculation to make sure that we can keep those premiums affordable. Social Security, uh, there's built-in, similar to Medicare, where funding is not changing a ton, but it is decreasing slightly. And it is accelerating the insolvency issue of the trust fund as well. Um, it was 2034 not that long ago, and now we're fully into 2033 when that shortfall will hit. It's not going to be bankrupt. It will only be able to pay 77% of the plan benefits. So if Congress does nothing and just leaves things as they are in 2033, um, everyone's Social Security paycheck will be reduced down to 77% of what it currently is. Um, if we wanted to maintain current benefits, Ryan did the research here, they would have to increase the payroll tax. That's the only solution that's being proposed here. There are other things that could possibly fix this shortfall. But if we just raise the payroll tax, it would have to be increased by 3.65%. If we wait until the insolvency date of 2033, then it would have to be increased by 4.3%. So obviously, the longer that we wait to fix this problem, the worse the problem gets. And this is just a chart that was released um, to show that we're kind of accelerating those shortfall dates on both Medicare and Social Security. So when budgets are passed, tax laws are passed, they always look at, well, what will this do over the next 10 years? And depending upon who you talk to, very different things. So the Yale Budget Lab says it'll be add about $3 trillion to the deficit by 2034. The CBO, which is the closest thing to the official number, says that it will increase the deficit by 4.1 trillion. Um, and if they keep kind of all those provisions, the things that we were talking about sunsetting, like the state and local tax exemptions, no tax on tips, the um, enhanced senior deduction, those types of things, it would actually add $5.5 trillion by 2034. Now, the other thing, it's very easy to confuse the term deficit and the debt. So the deficit is the shortfall. There's already a planned roughly $2 trillion deficit each year between now and 2034. So we're going to be adding an additional 3, 4, 5, maybe $6 trillion to that already planned $20 trillion shortfall that will be added to the $37 trillion national debt that we already possess. So that's kind of the accumulation of all those numbers. Now, the last projection comes from the White House, and they're acknowledging that it would be a $4.5 trillion increase to the deficit by 2034. But they're saying if they can cut spending, reduce waste, and raise money with tariffs, that rather than increase the deficit by another $4.5 trillion, they will actually reduce the deficit by almost $9 trillion between now and 2034. So what this chart is showing is um, the increase in the deficit or the projected deficits if the current provisions that are supposed to sunset, so those enhanced senior deductions, state and local tax, all those things, reduced tax on tips and overtime, um, that's the blue chart. If all of those provisions are extended, then that's the top of these bar graphs with the orange lines going through. So, um, and this is all just based on, the discretionary spending numbers. So, not too many of those are looking very good. So this is the Congressional Budget Office's projection on the additional revenue raised versus the tax reductions, and kind of where they come up with that additional deficit over the next 10 years. And when we look at the White House's numbers, they're planning on reducing spending. There's a planned growth of tax revenue because of tax cuts, which is an interesting take. There is planned growth from deregulation and energy policy. Another 1.5 trillion through discretionary spending cuts, and then approximately $2.8 trillion of revenue raised through tariffs. So that's where they're coming up with those numbers.
So Luke, I know you said that the deficit and debt of the country are different. So is this slide saying that we are going to be at an $8.9 trillion surplus? Or are we going to be reducing our debt by $8.9 trillion?
Yeah, so again, it's very easy to conflate the two. This would reduce the overall deficit over 10 years by that roughly $9 trillion. So instead of going more than $20 trillion in debt additional, we would only be going another $11 trillion in debt over the next 10 years if these revenue projections come through. So what are the likelihood that these numbers are going to come to fruition? So with the Tax Cuts and Jobs Act of 2018, the Congressional Budget Office projected it would add $4.5 trillion to the deficit over 10 years. In 2017, the national debt was just over 20 trillion. Today it's just over 37 trillion. With kind of that annual increase of $1 trillion that was already baked into the books. We're a little ahead of schedule on that 4.5 trillion that was added. Um, even if we take out the additional 4.6 trillion of stimulus spending because of the COVID pandemic. Um, but it's not that far off from kind of where it was actually projected. Um, at the time when it was passed, the projection was 1.5 trillion, but the Congressional Budget Office said it would be 4.5 trillion. So the CBO, which again is the closest thing we have to the official numbers, turned out to be much closer than the actual lawmakers that wrote the law and what their projections were. Um, so with all these reductions in tax revenue, but also services, where are the extra dollars going to? So there's a lot of business incentive here for research and development. Um, some of the more interesting things that are being incentivized are building spaceports. Um, interesting. There's additional credits for manufacturing, which is meant to stimulate, local U.S. economies, that type of thing. Um, and then there's also bonus depreciation, which is now going to be permanent for those business entities, where you can depreciate kind of those special purchases at 100%. Um, so some examples of what that bonus depreciation is going to look like: upgrades to business equipment, office materials, hardware, software, um, new vehicles for the business fleet, um, company jets, company yachts, your racehorse, things that are very beneficial for the average everyday American. Some of the other credits that showed up or were taken away, if you're making private sales of firearms and you're actually reporting that to the government, um, that fee is only $50, down from 200. Employer paid meals are now limited on what's deductible, so there are certain things there that are going to be changing. Um, there were some incentives for local businesses that if you paid your employees to bike to commute, that was tax-free income that is now going to be taxed. For our gamblers out there, if you're itemizing your limits, or your losses are now limited to 90% of your gain, rather than 100%. And then there's also some really nice incentives for kind of underdeveloped areas, and agricultural interests, as far as land development, leases, that type of thing. So, and those are mostly on the business level. So if you just have like some private agricultural land, this is unfortunately probably not going to help if you're looking to sell like your tree farm or something like that. So on to Wisconsin. We have, for the first time in Wisconsin, in a number of years, I can't tell you how long it's been, but retirement accounts are now going to get some preferential treatment for anyone who's 67 or older. The first $24,000 of your qualified retirement income will not be taxed. So that's going to include pensions, 401ks, 403bs, traditional IRAs. So, this is a really good thing for our senior population. And then obviously, if you both members of a joint household are over 67, that number doubles to $48,000 of tax-free income out of those retirement accounts. Wisconsin also brought back some film credits, a few other things to go along with um, different things that basically there's a lot of incentives to film a movie here, which we did have, I want to say about 10, 12 years ago. And actually, there were a number of movies that were made here that did help the local economies of places like Columbus, Manitowoc Waters, those types of things. Um, so there can be some advantages there.
So with that expanded retirement income exclusion, is there AGI limits? Am I allowed to make as much money as possible and still reduce my income?
Yes, so there is no phase out on that. It's your first $24,000 as an individual over 67 from those retirement accounts will not be taxed. So yeah, there's no limit on that. The other major change with Wisconsin is they have expanded the 4.4% tax rate. Um, it was there, but it was very small bracket. And now it's been expanded to kind of that 50,000 for an individual or 67,000. So these numbers go up to that next bracket. Um, so for a single filer, there's an additional $36,000 that'll be taxed at 0.9% less. So nice little reduction for kind of those lower income levels. So if you have questions, you can always reach out to your advisor, or if you want to schedule something with me individually, or Ryan as well. Um, you can always call our office, and we're happy to sit down and do tax planning meetings, basically from May until December. Um, get a little busy from January until April. Um, so if you have questions that way, and want to have a one-on-one consulting, by all means, yes. Here's some information on the sources. And I'm just going to go back here and answer a couple questions that came through. I have a question of if we can share the slides. I will not be able to share the presentation, but it is being recorded, and we will post this on our website. It's going to be a couple of weeks before it's available, because it does have to go through some compliance. But through our like monthly announcement emails that go out, we'll have notifications that it's available with a direct link to our website, and you'll be able to review this and, or just mute me and click through if you just want to see what's on the slides.
Are there any changes regarding deposits into Roth IRAs?
Not for this year. I think there is a scheduled increase starting in 2026, but we'll have to see if that actually comes through. But your normal limits are still that $7,000 per year. Um, and then there's a $1,000 catch-up provision if you're over 50 for $8,000 that you can put in.
And then with the tax on tips, is there any difference between cash versus non-cash tips?
So cash in the IRS's definition is legal tender. So if you get it in the form of a check, credit card, or physical cash, that's a cash tip. Um, a non-cash tip is, oh, thanks for all you did on the golf course today. Here's my 9 iron. So that's a non-cash tip. So that would not count. But any form of legal tender, um, even cryptocurrency, does count as a cash tip and would be deductible.
And then for the Wisconsin income exclusion, It said you said over 67. On the slide, it said 67 or older. It's
Correct, yes. Thank you for the clarification. It is 67 or older. So if you're 67, you would qualify for that.
right now, I've got one last question. Are there any changes in the MAGI for the Roths for contributions?
No, the limits are what they were at the beginning of the year. They are the same. So 240,000, I think, for a married filing joint return, I believe.
I believe it's 236 to 246, but
Thank
very
you.
close. I think that is all the questions I have in here.
All right, perfect. All right, well, thanks for everyone for attending. We do have some great events coming up in September. There's going to be some information on Social Security. October, we do have our pumpkin carving contest. I know it's always fun to have uh, kids of all ages, from grandchildren up to the kids that are in their 80s and 90s, showing pictures of their pumpkins being carved. And then we do also have our planned supply drive again in November, to support the Boys and Girls Club. So keep that in mind as we get closer to the holidays when people are in need. Also wanted to just give our best wishes and condolences to any of our Milwaukee area clients if you receive any damage from the flooding. Hopefully that's being taken care of and everybody is healthy and safe. With that, we're going to sign off and hope you have a great rest of your night.